Hi everyone, we have Mardochee Louis here. He's a great accountant. Wanted to bring him back in again after the last set of videos we did. So yeah, without further ado, Mardochee, can you just introduce yourself, tell us a little bit about you and what you do?
Yeah, thank you, Angelo, for that kind introduction. My name is Mardochee Louis. I am an accountant and I own my own firm, MGL Consulting Group. I am also an IRS enrolled agent. I help small business owners, entrepreneurs with their accounting and tax needs, and I also assist individuals with tax preparation.
So today, Mardochee came in and we're going to talk about a topic that's very near and dear to all of us, which is real estate taxation. Starting off, a lot of people get into real estate because they hear about all of the great tax write-offs that they can get from it. So can you talk a little bit about what kind of deductions a real estate investor can get?
Real estate investor, definitely. Some of the common deductions for real estate investors is definitely depreciation, which is essentially the cost of the home, and depreciation is definitely based off of whatever the useful life of the asset is. Another type of deduction I would say is repairs and maintenance, utilities, property taxes, mortgage interest. If you have a property manager, you could deduct the property management fees, any travel. Those are some of the typical deductions that most real estate investors would take.
Okay, now something like depreciation, like you were talking about, that is what's classified as a passive loss. So usually people aren't able to use real estate depreciation to offset their active income, which is your day job income. However, there is a certain subset of people that are able to use that rental property depreciation to offset their active income. So could you talk a little bit about that designation and how one becomes a real estate professional?
In order for you to be able to take that deduction as a real estate professional, you would have to have a loss for the year, and essentially we'll start with the depreciation and any other of the aforementioned expenses that we just explained. And if those expenses surpass the income that you received, then you will have a loss. So now if you're a real estate professional, essentially if you materially participate in the business, you are able to offset that loss against other active income.
So then continuing the discussion with depreciation, a lot of people will look at it as like, cool, I never have to pay taxes again, but that's not the whole story, especially on the back end of selling a rental property. So can you talk a little bit about what happens to your depreciation at that point and some ways to defer it?
Yeah, that's a great question. So essentially, when you do sell a home and you had a rental real estate and you did depreciate the asset, you did depreciate the home over an extended period of time, there's something called depreciation recapture. And essentially what depreciation recapture is, the IRS taxing you on the portion of depreciation that you took in the previous years. That's essentially what it is. So one way to avoid this is utilizing a 1031 exchange. And essentially what a 1031 exchange is, if you sell your home, you have 45 days to identify a property. And now once you identify that property, you have 180 days to close on that property, which is essentially 6 months. So you have 45 days to identify the property and 6 months to close on the property. And the funds that you do receive that are generated from the sale, you can't have it yourself. You need to have the bank manage it and go through escrow.
Qualified intermediary.
Yeah, pretty much, yeah. And if you're able to execute on this within the 45 days and the 180-day threshold, you could defer your capital gains, possibly forever, if you keep it going.
Yeah, and I mean that's a great thing in terms of like with estate planning, where with 1031s, the term is swap till you drop, where you just keep deferring it, keep doing 1031 exchanges until the day you die, and then your beneficiaries get the property at a stepped up cost basis.
Yeah.
So yeah, that's one of the big reasons why real estate is so tax efficient. Now we are mostly talking about rental properties here, but a lot of people will just, let's say, buy a home, or house hacking is something that's really popular nowadays, where you buy a multifamily property, live in one of the units, and then rent out the others. So can you talk a little bit about how it's kind of like a hybrid situation of a personal residence and an investment property, so how the taxes kind of work out on that?
Yeah, that's a wonderful question. The first thing you want to determine is how much of the home relates to business and how much is it related to personal. So what that means is you have a 2-family house, you live on one floor and you rent out another floor. Well, 50% of it is related to rental real estate. So what you would do is you would be able to take depreciation on 50% of the value of the home, and if you have any other expenses, utilities, taxes, everything like that, everything would be 50%. Same thing if you had a multifamily and you lived on one floor and there's 3 floors. So now 66% relates to business. So now it would be a 66% split. Another benefit of house hacking is Section 121, which is essentially when you live in a home 2 of the last 5 years, a portion of the capital gains would be tax free. So now what that means is if you purchase a home for $500,000 and then you go and sell it for $800,000 and you're a single person, exclusion, 250,000 of it would be tax-free. So in that scenario, you would take the 800,000, subtract it from the 500,000, and now you would have a remaining of 300,000. So now 250,000 of that capital gains would be tax-free, and 50,000 of it would be taxable to the taxpayer. And now if that taxpayer is married, that exclusion increases from 250 to 500,000. So now what that means is, in that same scenario, $500,000 home sold for 800,000, 300,000 difference. Now that whole entire 300,000 would be tax-free because it's below that 500,000 threshold for a married filing joint couple.
So then, like, as a kind of a segue from that, so let's say you are looking to house hack. One of the things that often trip people up is their debt to income ratio.
Correct.
Where, you know, you got a lot of credit card debt, car debt, all that, and then they're trying to qualify for a home. So can you talk a little bit about, you know, mortgage companies, what they're looking at in terms of debt to income, as well as some strategies to tweak your debt to income so that you are able to qualify for the house?
Definitely. You know, just to quote this, I'm not a mortgage broker, but, you know, based off of, you know, my experiences working with individuals looking for homes, definitely want to consider what your income is. Whenever you're filing your taxes, I always say this: you always have to have a 2 to 3 year plan, right? What is my 2 to 3 year plan financially, and will I be applying for any finance? Because most of the times when you're applying for financing, they're going to look at your tax returns, and that's going to be the basis for what your pre-approval amount will be. And part of that is the debt to income ratio that Angelo mentioned. So you definitely want to talk to your lender to see, okay, what kind of income do I need? And also you want to check your credit report, so you'll be able to, okay, based off this credit report, you know, what kind of income would I need to report? And just to make sure that, you know, you're reporting the income correctly. Entrepreneurs and real estate investors like to write off a lot of expenses, but you'll be mindful of those expenses when you're going for a lending decision.
That's everything, and thank you again, Mardochee, for coming in. Can you just tell everyone how they can find you, like your social media handles, website, contact info?
Thank you for that, Angelo. I could be found at Doty Tax Guy on Instagram. I could be contacted on my cell phone, 973-626-8852, and also via email at mlouis@mglconsultingllc.com.
And we'll make sure to put all that information down in the description so you can easily find it. So, hey, Mardochee, thank you again. Always a pleasure.
Of course, Angelo. Thanks for having me.